Okay, with that, let's move to our second panel. And for that, our moderator is going to be my colleague, Angela Ullum. And I'm going to turn it over to her to introduce our panel. Angela.
All right, terrific. Thank you, Andrew. So I'm Angela Ullum. I'm a partner in our finance practice out of Chicago. My focus is in structured finance, and I work with everybody from banks, corporates, asset managers, insurance companies. And so it might, in previous years, regulatory capital wasn't the most scintillating dinner party conversation, but it's turned into that. And so I'm really excited to have the panel with me today. Via video, unfortunately, he wasn't able to be here live in person, but from London, we have Mansoor Hussain, who is the Global Head of Research for Financial Institutions at Fitch Ratings. So thank you for joining us virtually. Tom Michaud, who is the President and CEO of Keefe, Bruyette & Woods, which is an investment bank specializing in the financial services sector. So you might imagine he's been very busy these days. And my partner, Anna Pinedo, who represents insurers, investment banks, financial intermediaries, investors, and financing transactions. And so who's been spending a lot of her time, I know, counseling clients about the impact of these proposals. And so to help give a little bit of kind of history to where we are, Tom, can I ask you to give a little bit of background of where we were in the few years coming up to this proposal? Just general kind of economic conditions, the pandemic, what was going on with the banking system before this release?
And thank you for having me, by the way, and thank you for the great discussion today. There have been some very big trends that were underway. Thankfully, a 100-year pandemic only happens every 100 years. And the forces that came to work to help defeat the pandemic really had a tremendous impact on the banking industry. And I think when you think of some of those forces, you would think about what happened with quantitative easing and what happened to the deposits in the United States. Some of the work that I've looked at is previous to COVID, one of the most predictable things you could look at was that FDIC deposits grew about 4 to 5% every year. And that makes sense, interest compounding GDP growth. Then when COVID happened and you had quantitative easing and all the stimulus, there was a tremendous surge of deposits of roughly 38% in a very short period of time. And a lot of that liquidity found its way to the banking industry when interest rates were essentially zero. Now we're unwinding that, and that's something that's really never been done before, and it's having very big impact not only on the economy, but on the banking system. And as we know, we've talked a lot about capital, but liquidity matters too, and the loan-to-deposit ratio is an extraordinarily important ratio for banks. And as deposits are shrinking, that is a natural constrainer of credit, which is in part doing probably what the Fed is looking to do with monetary policy. So you have that occurring at that moment, which put tremendous pressure on earnings for banks as their cost of funds continues to remix as deposits become more scarce and U.S. Treasuries are just great competitors for the banking system. And then you have the Fed, which is trying to cool inflation by slowing the economy. And in fact, very good chance they're going to slow the economy, which brings credit into play. So when you look at it right now, what you're going to see, and you've got the bond moves as interest rates have gone higher. So you've had the industry is more levered on tangible capital than it's been because of the swelling from the COVID deposits, because of the mark to market from the bonds. You've got the investor community paying attention to what's happening to the economy, especially with credit quality, let's say commercial real estate, for example. So that's an area of concern. And now you're going to be putting on top of this, what we talked about earlier, 19 to 20% higher capital ratios. So a big constraining moment for the banking industry, which is going to have an impact on the economy and also going to have an impact on where the banks sit in the entire financial services industry. So these are powerful forces that were underway before we got to the Basel Endgame proposals. And I'll wrap it up by saying bank stocks kind of say it all. Bank stocks are down 25% on the year. The S&P 500 is up 10%. Unfortunately, there's even been articles written saying, are bank stocks even investable while all this is happening? So I think you have to look at the big picture. Now, I personally think they are, but I can tell you the concern is high.
Wow, yes. I think that's quite an impact. And so, Mansur, if I can turn it over to you a little bit. I know that Fitch and you have been spending a lot of time and doing research into what this is going to mean. Can you explain a little bit about your view and the overall reaction for the bank sector as a whole?
Thank you, and thank you for having me, and hopefully you can all hear me correctly. Perfect, grand, fantastic. So yes, I mean, I agree with Tom's great survey of what led us here, and ultimately, I think it's fair to say that banks are still experts in managing through regulatory change. That said, from our perspective, both the Endgame and the long-term debt proposals will have mixed credit implications for bank credit investors and for banks. Particularly, that will vary depending on the type of bank and the size of bank and the shock that the bank goes through when phasing in these new rules. Generally, though, at a high level, the proposed improvements in the quality of common equity tier 1 capital in terms of the change in the numerator criteria, along with the increased quantum of common equity tier 1, all other things remaining equal, would be positive for senior creditors to banks. And a meaningful increase in bank holding company long-term debts based on the long-term debt requirements, depending on the affected bank, should, in our view, reduce loss severity on the bank holding company senior debt in case of the bank's default or failure, and it will increase credit protection for operated bank creditors and generally contribute to more stability in funding profiles, all of which have positive credit consequences. But what's still a little bit unclear is how banks will change their business mix and what, if any, unintended consequences the new rules will have. So it's probably a little bit too early to say if and how bank ratings might be affected, particularly if we take into consideration the transition periods that can be lengthened, and the rules themselves might well be changed based on the feedback from the industry and indeed even from regulators that we've heard. I think the point made by Tom, though, around the long-term debt requirement is quite interesting, because on the one hand, it should increase, as I've mentioned, the stability of funding, but at the same time, the hit on net interest margin for banks comes at difficult times for banks that are already managing, particularly the smaller kind of regional banks, mid-sized banks, from a general surge in funding costs and difficulties in retaining sticky deposits. So it's an incremental add-on problem from the funding perspective, which I think can negate some of the other kind of structural improvements in funding that banks may find. And whilst I mentioned that the increase in common equity tier 1 buffers generally are welcome, there is a reduction in overall risk sensitivity in the framework due to the use of the dual stack approach. And indeed, for the US's gold-plated proposals to entirely eliminate credit models from prudential capital estimates, which I think is going to be much harsher than any other regulator has proposed so far. However, as I've said, banks have always adapted their businesses whenever the rules have changed, and we've seen this in the past. And if you remember the impact of Basel II in the early 2000s, banks then had to implement rules, build up significant capital while ensuring their businesses continued to make adequate returns, and they managed to do so. So let's just wait and see.
So maybe we could just, Mansur, pick up on some of what you said, some of what the director said in his remarks, and some of what Tom said. So of course, banks have adapted. They've always adapted, but in the adapting, to the director's point, a lot of the adapting in the post-Dodd-Frank era in reacting to the 2017 changes was adapting that moved businesses and that moved certain transactions and assets from, to the director's point, right, from banks to non-banks. And we saw that in the mortgage industry with a lot of mortgage servicing and a lot of mortgage origination moving from banks to non-banks. So maybe if we parse some of what was said in the first panel and what was said during the question period, and maybe take apart a little bit in both the first proposal and the long-term debt proposal. So, and your Fitch analysis and Tom's observations, how are you, and maybe Tom can comment as well, how is Fitch thinking about the proposals in terms of just European, or let's say the foreign banks versus the US banks, and opportunities for, let's not say arbitrage, but opportunities for differences, or to move certain businesses that are presently conducted in the United States, maybe to Europe, or for certain businesses maybe to find their way to Europe versus the United States, just based on the GSIB surcharge, the changes to the cross-jurisdictional activity, and other the movement that will result in how certain foreign banks are categorized, and moving them to more onerous categories.
I mean, I think it's a great question. You've already touched on some of the points of constraint that may well limit the degree to which foreign banks choose to deploy their home country balance sheets. And as many of you already be aware in the audience, I mean, there's various flavors of Basel implementation which reflect national, prudential, structural, and sometimes socio-political priorities. But it's fair to say that the EU-specific implementation probably strays furthest from the global standard in terms of its relative leniency, whereas the US proposals appear to be, certainly gold-plated in certain key areas, and appear so far to be the toughest proposals thus far. I mean, ultimately, the EU banks will continue to receive benefits of the internal models, under the standards approaches to about 27.5%, if you like, of the benefit of internal models, whereas US banks can't use the internal models. So generally, that may well benefit capital requirements for slightly more risky exposures, and also on the least risky exposures relative to US banks. I think really, when we're talking about arbitrage and issues on balance sheets for the credit, we're really focusing on corporate exposures and institutional wholesale exposures. Retail exposures are largely a home country game, and there's usually silos and restrictions on to what extent banks compete on that. And I think really we're speaking about the systemically important banks in that regard, in terms of actively competing, EU banks actively competing versus their US peers. I mean, EU banks' operational risk charges won't vary by their historical losses, whereas the US banks' risk charges may well inflate depending on the degree of historical losses. And unadvised exposure limits won't count towards capital requirements in the EU, but will be set to add to risk-weighted assets for US banks. So ultimately, what this means is that certainly, I think, for these, not necessarily on the IG side, but less on the mid-sized corporate side of things, there might be a small advantage for EU banks vis-a-vis their US peers. I think there may well be some advantages on the trading book side of things, particularly because EU banks will have so much op risk charges versus the US peers, but also they won't have to capitalize their CVA risk charges for trading books. And we heard earlier in the first panel, the primary dealers trading desks are very sensitive to capital requirements, and so certain activities and trading desks might get switched off. I think the exception may be where the US banks run prime, very less risky corporate securities books, where the US approach to apply a standards approach for those high quality securities trading operations may advantage some US primary dealers versus their EU peers. I mean, ultimately, you mentioned the GSIB surcharge, and in particular the cross-jurisdictional metrics. And that's important to consider for an EU bank looking to use its balance sheet heft to move in on US banks' customers and or better compete in Europe against their US peers, because that's ultimately going to be one of the kind of multi-dimensional Tetris kind of elements that these banks have to consider. Do they have capacity within that cross-jurisdictional surcharge, that metric, to basically take advantage of that balance sheet heft? And ultimately, we might see some European banks finding that they can put some of the credit back onto the ultimate parent's balance sheets. But structurally, there are
Yeah, so just to bring Tom back into the discussion. Yeah.
Yeah, so I think that was an interesting conversation about foreign banks versus the American banks. I think where the arbitrage is going to be even more noticeable is with the non-banks.
Mhm.
And recently, the FDIC chairman mentioned that 2/3 of the mortgages in America today are made by non-banks. And you would think that a home mortgage is the essential part of a consumer's financial life in many ways. And you would think that that would be at the epicenter of what a bank does. But the primary reason why they don't do it is really the economic value of making a mortgage primarily is in the servicing of that mortgage. But with the capital charges today, as high as they are in servicing, it's essentially forced it out of the banking industry. Leverage lending has essentially been forced out of the banking industry. And then as I was listening to the conversations this morning about this operational risk capital charge that's coming, I feel like I've seen the full life cycle of during the global financial crisis, the leading securities firms in the United States become banks overnight. And now they're going to be charged more for being an investment bank with these capital charges. So who's going to get caught in the middle of that circle? It's going to be the companies that need capital and access to capital. And if the banks aren't in the center of it because of capital restrictions, other entities are going to do it. It doesn't mean that there isn't going to be financing. It's just going to be done by non-banks and non-regulated entities. And so it's critical that this finance happen, and it will happen. The question is, will it happen in the banking industry and to what degree? And these proposals absolutely have implications. And like I said earlier, if you want to go anywhere to see that, look at the home mortgage market in America today.
I'm
I
sorry.
actually have a question for you. And so we've been hearing a lot about our predictions, expectations, the theory of what we think will happen from these rules. But Anna, I know you spent a great deal of your time, especially over the past several months, talking to actual participants in this market. Have you found them, instead of making predictions, taking steps right now, thinking about how these proposals are changing the things they're thinking about, the lines of businesses they're thinking about?
Yes. Oh, absolutely. So, we talked about the comment period coming to a close in November 30. We talked about the UK putting off the deadline for implementation, and we talked about the implementation being, relatively far off. But banks and Tom can certainly speak to this much more eloquently than can I. Banks are inherently conservative, and they're going to react now to even proposals, even without waiting to see how the proposals ultimately end up. And so they're going to begin now to affect changes to their business just in light of what the proposals say. And so they're already thinking about how certain of their businesses are impacted or may be impacted by the proposals, and which of those business lines are going to be negatively affected by operational risk issues, by market risk issues, and thinking about de-emphasizing and whether de-emphasizing is reducing their allocation of resources or ultimately exiting certain business lines that attract too much capital to business lines. And that could be things like equipment financing, things that we already, an accentuation of trends that we already saw in the post-Dodd-Frank era. Whether it's exiting those businesses, trying to sell or monetize their interest in those businesses, and looking for investors that are non-bank investors, to Tom's point, private credit, private equity, or other non-bank financial investors that have an interest and an appetite for those intermediation and credit extension functions. So all of that, I think, is already underway. In the immediate aftermath of the proposals, there were already a number of banks that made announcements to that effect.
Yeah, I think those were all great points. And just if I could add, banks are very conservative. And I said this to someone earlier this morning, notwithstanding, we just had 3 of the 4 largest bank failures in American history. The industry is actually very sound.
Yes.
Notwithstanding that, I will acknowledge that did just happen. The industry is very sound, and banks can't afford to be ready, for example, on the day they become 100 billion. They're going to need to be ready when they're 70 billion. And their regulator, and I would think, especially in this heightened moment, is going to want them to be ready. So many of these are the institutions that my firm and I deal with regularly. They're all talking about it and thinking about it. And that's going to have growth ramifications throughout the industry below 100 billion. The other thing is all these new capital and other provisions come with an expense. Our analyst believes that earnings could be reduced by 2 to 10% if they were all enacted as said.
Yes.
So, and then and part of it is you have to build the apparatus to manage all this, which suddenly becomes a force that favors scale, which is, and it was said earlier that you're going to see banks need to be bigger to be able to have the capacity to afford all the regulation. And something that we didn't talk about today that's also being watched, but doesn't seem to have a lot of momentum yet, is an item that was mentioned in the president's July 2021 executive order in favor of open banking. If open banking becomes the policy of the country, then suddenly you'll have a lot more competition from fintech and other niche competitors, which again puts pressure on profitability. There comes a point where it's not hard to see this trend of banks as a percentage of the entire financial services sector continuing to lose market share.
Yes.
And that's why the statement is said, we really need to think about, when you talk about endgame, what's the policy endgame? What are we looking for to be? What do we want? Because if you keep pushing risk out of the banking system, it's just going to go somewhere else.
And I think we're beginning to see this somewhere else, right? There have been a number of comments of late. For example, the FSB put out a statement, and various other quasi-regulators or agencies have put out statements, and some rating agencies have put out statements regarding the growth of private credit and the fact that there is sort of this circular aspect to it as private credit becomes more and more significant and continues to grow. Banks lend, of course, to private credit and fuel the growth in private credit. So it does, the exposure or the risk is magnified there.
And I would say certain banks, I believe the biggest banks lend to private credit.
Yes, of course.
And what I really worry about, and something I'd love to have industry observers make sure they're paying attention to, is 97% of the banks in America are less than 10 billion in assets. Some of those banks are some of the best banks in the nation, but they don't typically have a broad product suite of what they do. So that leaves about 145 banks that are above 10 billion. The top 25 have 60%-ish of the deposits. So that leaves about 110 banks in the middle. And those, I think, are the banks we're talking about, because they're the ones who are going to get squeezed the most, who don't have a $500 billion balance sheet to offset the expense of building all the regulation compliance teams around what's being talked about.
And in many respects are being forced to have more homogeneous, less interesting business models because they're penalized by a lot of these regulations for having more interesting business models or accommodating or finding opportunity. And, you know, I think that's an important
When I
comment.
talked earlier about the $70 billion banks needing to pay attention, those 110 banks in the middle are in that class. So they're the ones who are really feeling pinched at the moment, as well as fighting against the too big to fail implicit guarantee that is around the marketplace.
Yeah, Monsieur, do you want to join in with any observations?
Look, I think this is a fascinating conversation. And I think one thing that comes to mind by basically dumbing down the rules by making everything standardized, in our view, could actually incentivize increased risk taking to a degree. Because if you're basically having to hold much higher levels of kind of regulatory capital against something which requires economically very low capital, then you just won't want to be in that business. So, you know, the mortgages, residential mortgage has been an excellent example. If it's low risk, why hold it onto the balance sheet? Just move up the credit risk curve to other more riskier lending, where at least the margin is better to compensate for holding that additional capital under the dual stack approach. And I think to the point of the non-bank competition, I mean, we've seen a lot of growth in the private credit sector, and of course the FSB and other organizations are monitoring this. But I think the insurance companies are also muscling in. And I think there might well be a natural home for insurance companies to take on the credit intermediation, particularly for longer tenor, longer duration assets, where they basically have a natural partner and natural offset with their long duration liability. So I think there are some potential advantages with insurers potentially taking up some slack from the banks. But yes, it is congested in terms of the competition from non-banks. And yes, the fintechs, I think the open banking, open finance is an interesting element. In Europe, they've had open banking for 8 years, and it hasn't really had an impact yet.
Monsieur, just a thought to interject, I think, on insurance.
I was just going to say, we've been seeing the same trend, which is insurance companies providing consumer and commercial credit. And it's a really interesting thing to think about, the fact that insurance companies are using insurance premiums to provide loans to corporate middle market America or commercial mortgage rather than banks with deposits. Now, banks are doing it with deposits. I think we're speaking more about the growth rate. I think the growth rate's probably faster in the insurance industry today than it is in the banking industry. And maybe some of that's temporary because of the pressure on deposits. But I think it's enough of a factor that it's worth paying attention about how this arbitrage is all beginning to work.
Well, and I actually have a question. I'm not certain who the best one of you, maybe it's all of you, to give your insights. But we've had a couple of themes run through this. This morning we heard, either get bigger or disappear. Sounds like, Tom, from your perspective, is at the 110 banks. Also heard Monsieur comment about is safer lending leaving the banks, because when you look at how profitable it is versus the capital. So what do you think is going to be happening? Do you think that business lines or divisions are going to close down? Are asset managers or insurance companies going to be picking up particular kinds of work?
I personally believe it. I personally believe it's an overtime market share shift. Just like when the regulators changed the mortgage servicing right regulations around capital, it didn't happen overnight, but it just started the process. And last year, I think it was last year or earlier this year, when Wells Fargo announced they were selling their mortgage company. Is that earlier this year? I mean, this year has gone by fast. It's starting to blend together.
Last year.
Was it last year? Okay. So we'll say recently. Recently.
Yeah.
Recently, and Wells Fargo for my entire career has been one of the major mortgage underwriters in America.
Yeah.
It just took them a little longer to get to the decision that others have made. So it'll happen. The question is, and they'll be ramp up a speed and then it'll slow down. But it's where's the compass pointing? And I think the compass is pointing that the industry has a lot of extra expense on it at the moment, and possibly growing with what we've been talking about today.
So do you see, Tom, an opportunity for M&A in the bank sector among the smaller institutions that stay under the 100 billion?
So Congress changed the interstate banking laws in the mid 1980s. We had 14,000 banks then. So the consolidation's been going on since that entire period of time. And it's always been ebbing and flowing. But diversification as well as scale have been important elements of consolidation for a long time, whether it's regional diversification by product, I thought coming into this year, commercial banks were going to be more profitable than consumer banks.
Yeah.
And then March happened, and suddenly, and commercial banks by definition tend to have more uninsured deposits. Suddenly, that's not a great place to be. So I now wonder if you're going to see banks that were very focused on being commercial banks now think about combining with a more balanced bank. So I do think that the market dynamics would be encouraging of there being more consolidation. Also, if you were to think, there could be banks that are approaching a big threshold. Let's pick 100 billion. They have a choice: spend the money to build it, or to combine with a bank that already has it. So that's going to be a big conversation that happens with those management teams.
So consolidation in the under 100, right? Because we see a lot of banks that are just fighting for deposits and struggling to find deposits and struggling for other ways to deal with funding in the under 100 category.
Yes.
So consolidation in that lower tier.
I think it will continue, and that has been the trend, and I think it will continue for diversification reasons, like you just said, maybe for deposits, or for an effort to say, hey, we may be better off being together to afford what it's going to take to make fintech investments around regulation, and also you have to have a certain level of return on capital, or you're not going to be terribly appealing to investors. And if you can't raise capital, you won't be able to grow like you might like to grow. And that's why we don't have nationalized banks. So you'd like to have that life cycle working too.
So let's talk a little bit more about the long-term debt requirement. It's been discussed, obviously. We have it for the GSIBs and we deal with it for the GSIBs, the long-term debt requirement. To be eligible long-term debt, the debt has to be plain vanilla. It can't have any incentives to redeem, no credit sensitive features. But there's this new requirement in the proposals that it can't have a minimum denomination of under 400 million. And the theory behind it is to discourage retail holders. And that would be a change as well or an amendment to the GSIB requirement. A number of banks find that concerning. As you know, from a ratings perspective, do you think that the LTD requirement is, well, I guess you're looking at it from a creditor perspective. So you're probably just fine with the long-term debt requirement, but there's an interplay between the long-term debt requirement and LCR issues. I don't know if you've commented on LCR as well.
Well, I mean, I think it might surprise you there by saying that although in theory the debt buffer requirement definitely has some positive credit consequences, particularly for reducing loss severity at the holding company and bank level opco, there are some downside fundamental risks. I mean, ultimately, it's more expensive. It's basically, although it does improve the structural kind of features of the bank's liquidity, I think it could obviously result in, changes in overall kind of funding mix, which might not necessarily be advantageous to concentrate certain funding. And ultimately, I think it's also going to be a bit of a drag, if you like, on the funding cost pressures, because ultimately, there's a 12 bips impact on the NIM that was mentioned. The US banks are already facing revenue and funding cost pressures, and there's elevated loan losses potentially coming our way, depending on the state of the economy and commercial real estate. And so ultimately, I think these kind of pressures come alongside, this lower loan growth, which higher kind of loan to deposit ratio may well imply, which we think really will be potentially troublesome for the regional and mid-sized institutions. And I think that's probably where our concerns are with regards to potential downside risks.
Tom, what do you think about the long-term debt requirement and its effect on NIM and LCR and other issues?
I believe that profitability of the banking system matters. And I don't think, I'll look at it from the world of investors. I don't think that equity investors equity investors, that's important to them to get them to invest.
Mhm.
And I think you want to have a banking system that can attract capital so it can continue to provide growth in the economy, which is their function. So, and I thought the comment that was made earlier by one of the guests about long-term debt probably wouldn't stop a bank from failing, but might make it less costly at the point of resolution. That actually, I think, probably makes a lot of sense. So it's more a little bit about protecting the deposit insurance fund than I think it really is making depositors or investors feel safer about their bank because they have more debt.
Well,
I just don't think that's going to happen.
Yeah, I mean, I think a common equity holder just doesn't care, right? I think most common equity holders are oblivious.
And or even counterparties, I would
Yeah.
think, because I would say there comes a point where you've already achieved enough.
Mhm.
And I thought the conversation this morning around 15% total capital, my opinion would be that's enough. None of the banks that failed because the market thought they didn't have enough capital.
Right.
It was more about the mark to market issue and what we learned other issues. So I don't think that inherently is going to change how counterparties necessarily think about their bank.
And what about the sales? Sorry, Monsieur, go ahead.
So I was just going to say, in terms of the interaction with the LCR, you know, this measure, long-term debt requirement, is principally about the gone concern issues. And I think on a going concern perspective, the interaction with the LCR, it doesn't change one iota the scenarios that led to failures of the banks, you know, earlier this year. It won't change the calibration of the outflow estimates which the LCR hinge upon. So you can still have a run on the bank exacerbated by social media discussions, which you see some improvement in structural liquidity, but not sufficiently enough to prevent the run that we saw earlier this year. And I think that requires a more deep-seated analysis of how banks' funding and resilience has changed now in this age.
Well, one thing I would add to that is I felt that Dodd-Frank did a very good job around liquidity and capital. And I felt like that's why the industry was and is in a good shape, again, notwithstanding the 3 bank failures, but the industry by and large, and again, those companies had enormous amounts of uninsured deposits. That's one of the big lessons. But I think that Dodd-Frank went far enough on liquidity and capital that you didn't necessarily need to gold plate this endgame.
And do you think that there's a real concern about retail in this post credits, you know, UBS Credit Suisse world, right? That's the rationale that the banking agencies are using, or the pretext that they're using for why long-term debt can't be sold to retail. Do you think that's a realistic excuse in the United States?
I mean that this debt then shouldn't be sold to retail.
Sold to retail, that we have to stick this
Does that mean it
$400,000
couldn't?
denomination on it, but we can still sell common stock of banks all day long to retail.
Yeah, that's wow. I mean, if you're selling it to a mutual fund, those are retail investors in the mutual fund. Boy, that would be a hard thing, I think, to regulate. And also too, I think it gets to another point, which is we have supervisors. We can't, via rule, anticipate every change. We didn't anticipate what social media was going to do to the depositor confidence. I mean, I would encourage everybody to go find a Financial Times article from February 22nd, which basically told you everything that was going to happen on March 10th. About Silicon Valley Bank, all the issues that there are a few other things that we learned. We didn't know then that $13 billion was in their top 10 deposits and the concentration was bigger, but everything was in plain sight. We just didn't know when the psychology was going to change. That was the perfect storm that we didn't see coming. You can't put rules in place for every circumstance, in my opinion. But you could go too far with the rules and start to not make them as attractive to investors, which will affect the growth generation for capital, which could impact economic growth, and more activity is going to happen outside the regulated world.
I mean, I would
I
say,
actually want to.
so I was just going to say that not sticking it to the retail investors in terms of long-term bonds, in one way that makes sense because ultimately regulators or resolution authorities might hesitate to impose the losses in case they have to do it if they want to basically make the bank viable again by recapitalizing it. But ultimately, I agree with the point Tom made that, look, retail investors are allowed to buy equity, which are usually first in the firing lines. So you've already kind of lost the argument in that sense if you then retail investors then hold the bonds. But we've seen it in Europe, in Italy, where the regulatory authorities, they don't want the retail investors to hold these bail-inable debts, because ultimately it might stop some action from the authorities when it's needed.
So, Monsieur, a point that we haven't yet really had time to explore that I don't know if Fitch has commented on, are there certain types of banks, maybe the credit card banks, that are disproportionately impacted by the proposals, or other categories? I'm just throwing that one out there.
Sure. Well, I think the credit card banks, on the one hand, the Capital Ones and Amexes of this world, in one sense, they're not affected by the outflow proposals because they run using standardized approach anyway. But on the other hand, they've got a hit from the operational risk charge facing their fee income streams. And they've also got a hit from the credit conversion factors that apply to converting those undrawn facilities, the kind of drawn standardized approach equivalent. So that is definitely going to be grit in the wheels. It's definitely going to make them monitor more closely the behavior of their clients, particularly because there's a benefit to, if you're a monthly transactor and you repay in full every month, like for Amex customer, where that receives some more beneficial treatment versus having their balances accruing and growing over time. So what that means is that facilities might become far less generous to Main Street, to customers. And that's obviously going to have an impact because small corporates, SMEs and retail customers can't turn to the capital markets for credit cards or facilities, that they're focused on the bank. So really it could result in a change in pricing and therefore a deterioration in availability of facilities, which would be a negative.
So I have a whole list of questions, but I'd like to give people here in the room an opportunity if you have any questions for our panelists or any thoughts to share. Wow. Okay. Is that our third wow for the day? So just listening to the conversation this morning, and I'm going to put people on the spot and go off script. We've heard a couple of themes about, systemic risk and where are we really reducing it or increasing it, and some concerns about moving some of these lines of business to unregulated entities. Mansour or Anna or Tom, do you have any thoughts about what that might look like?
So which type of risk?
Basically we're talking about systemic risk, and we're trying to make the banks much stronger. But it sounds like the theme that I'm hearing is that it's just going to push a lot of this lending, potentially like the safer lending out of the banks or alternative lenders, asset managers, insurance companies.
I mean, I'll just say my own opinion is I do think that there are certain categories where the model, just like the director said, the model is just, there's an arbitrage for capital. So it's cheaper just to happen outside of the industry. So I do think that builds a systemic risk, but it also look at size, because remember, you could go to some of these alternative managers. If you added up all their funds, they might be the 10th largest bank in America. So, but that doesn't mean that all the funds have the same risk. They're diversified, but these are becoming major players. And I don't know if you saw too recently that S&P changed their membership rules about classes of stock. And so now some of these non-traditional lenders can be added to the S&P 500. So their access to capital is even going to get better. And the index fund and passive community now is going to need to own their stock. So that's another event that's playing out right in front of us right now. So, and I would imagine that over time you could see the FSOC start to pay a little more attention because it has the power to do that. But as of today, to me, I don't think you're seeing the same degree of attention around policy as you are in the banks. And think of even the aftermath of the FTX failure. you still haven't really seen any real regulation or rule that's likely to be implemented soon.
I mean, I would just add to that, I think part of these rules are intended, there's an intended shift of exposures from the banking sector to the other sectors, particularly, as I said, the insurance sector. Certainly, if we look at what's happening in Europe, insurers seem to be the preferred holders of longer term debt funding from politicians' perspective and potentially from the regulator's perspective. And that's an intended outcome. They're changing the rules to make it preferential. And I think we're going to see something similar happening in the US, just because insurers, life insurers, generally have less of a run risk. They have less of a liquidity risk. So why not allow them to partner on some asset classes where that particular lack of run risk might be a positive attribute? But I think the point here is around very unregulated sources of finance that become very systemic will then need some kind of backstop, regulatory, central bank backstop, which currently doesn't exist, which could then lead to a crisis if that particular source of lending does become systemic. As I think Anna's mentioned, the FSB has been tracking this, and I think that's going to become an increasingly a focal point for authorities. And I think it's probably long overdue.
Excellent.
Hey, I guess this question is mainly meant for Mansoor because you mentioned it earlier, but I guess anyone could answer this. Could you expand a little bit upon the potential for arbitrage between the EU and the US, specifically regarding trade?
So you can repeat the last part of the question again? I didn't manage to catch that. The EU.
Yeah, could you between the EU and the US, specifically regarding trade?
Treasury.
Trade. Do you mean trade finance or
Yes,
trade?
trade finance.
Trade finance.
Yeah, so there are preferential EU rules for trade finance, specifically as it relates to self-liquidating trade letters of credit and other kind of facilities, which basically have been given preferential bias in the EU rules, which have been finalized, by the way, which basically means that in theory, the EU banks will be able to operate on a better footing than their US peers, all things remain equal. And that's, if you like, definitely, it could lead to an unlevel playing field, one can argue. But on the other hand, the European banks will argue they've got structural balance sheet differences, which means that the imposition of the rules means that there's a much bigger overall capital increase in minimum requirements versus their US peers. So they would argue they need this leg up. But I believe there is a structural, a capital advantage given to EU banks versus US peers in this space, yes.
Tom, I think it was you who mentioned a shift in kind of like these trends over who the lenders are. And we've been talking a lot about kind of banks versus alternative lenders. But if you're thinking about these trend lines and thinking about the current, if we can use the word arbitrage between the US banks and foreign banks, between like then foreign banks and alternative lenders that aren't banks, do you have any predictions or thoughts about how that balance might play out in the next year or two or longer term?
Between foreign lenders and
Well, US banks and foreign
Yeah.
banks, and then foreign banks competing with asset managers, insurance companies, and others for. So if somebody's eating the US bank's lunch, who's it going to be?
I probably all of the above, and everything happens gradually is my sense. Now, what's interesting is, I mean, the US banks have been leading the world in terms of performance in global finance. I mean, I would measure that based upon the profitability. They've been more profitable, which when you're more profitable means you can invest more in fintech, you can invest more in growth, you can generate more internal capital to grow. So I would use that as a measure so their profitability has been better. But that's also because Europe had negative interest rates. And I never would have thought, no bank was designed to perform well with negative interest rates. So it's not surprising that as interest rates have stopped being negative, you've seen the profitability of the European banks really improving. So they're going to get a boost because they're not going to have negative interest rates to fight against anymore. But as part of when my firm started studying and researching these alternative lenders, I called a couple of them up on my computer to go to their IR site on their website, and I saw where they had offices. It looked like I could have been looking at any one of the G-SIFIs. The big ones, they're everywhere. They're in the Middle East, they're in Asia, they're all over the world with offices. So they're building global finance non-lenders is what they're building, many of them. So they look like global. So I think that they will be competitive for all of the above.
So Anna, you made the point with a little bit of surprise, why are retail investors not permitted to invest in long-term debt, but they can invest in equities? And so, again, this is some speculation and predictions. What will be the impact about these shifting trends away from US banks as lenders, about banks getting out of less risky businesses because they're not as profitable? Any predictions or thoughts about what that might mean for kind of US consumers or US corporates, the customers of these banks? Is this a good trend for them, or do you see potential problems?
Well, I guess, you can answer that question a whole bunch of different ways. From an access to credit perspective, I think some of the things that we've talked about obviously raise concerns in terms of reducing access to credit for smaller and mid-sized businesses. So if you're, depending on what kind of consumer you are of bank services, you can certainly see your access to credit reduced and your access to different banking products, different credit card products reduced. So that is certainly problematic. And certainly companies that are funded by private credit or private equity probably have less tolerance for and generally don't see themselves as a public good or a public interest entity in the way that community or regional banks have, and don't see themselves as having that nexus to the community in the way that banks traditionally have had, and don't see themselves as having the relationship that banks have had with their communities. So they won't necessarily offer the products that community or communities have, will need. So fewer products for certain types of communities generally, but we've already seen that, right? We've already seen that in the mortgage world, and there have already been, a number of issues with access to housing. So it'll just be more of that, I suspect, in many respects.
Tom, you were nodding. Do you? Mansur, go ahead.
So I was just going to add to that. If you have the non-bank sector started to intermediate, where perhaps smaller banks operated on a more community spirit level on a one-to-one basis, and instead these non-bank lenders use digital platforms that use, for instance, AI and machine learning to differentiate between borrowers, you might well also have potential shifts in kind of credit lending based on tracking certain behaviors, which might alienate certain socioeconomic classes, might freeze out certain communities and persons based on unknown means, which is also a potential peril, I think, when you look at non-banks taking over from banks.
Yeah, I think that you'll see the geographic connectivity over time become less, especially, again, I'll go back to those middle 100 banks that can offer a broader suite of products. If they're less available in the market, consumers and small businesses going to be forced into fintech providers or national lenders, and it's just going to be a different experience, I think, especially if they get into trouble. I think there'll probably be a little bit less flexibility, and also I think the access of that capital will be a little more finicky. If you're a regional bank, you're embedded into your region, and that's what you do, and that's what you exist for. Whereas if you're a national player and you think it's not a great moment to be making a certain type of loan, you can turn the spigot on and off if you're a fintech or some other player.
That's a really interesting point, is that this might adversely impact different demographic or geographies.
And it would be also, it could be pro-cyclical. In other words, if the economy gets rough, you could really see less credit be available if it's not an entity that's really embedded into the community.
Okay, any final questions? If not, any final thoughts or parting words of wisdom from any of our panelists?
No, I would just encourage people, obviously, to comment, whether through trade associations or otherwise. And obviously, it's a short comment period for very complex proposals. We thank the New York State Bar Association for their partnership in hosting the session today. And of course, all of our wonderful speakers for joining us. So thank you very much.
Thank you, everyone.
Thank you.
Thank you.